Hi everybody, this is Seth Martin and welcome to the Middle Class Investor. Today is 7/27, July 27th, Sunday evening, about 9 o'clock. And I want to thank you guys for coming in and watching the videos. We had still really nothing has happened over the last, really since about the end of June. We've just been kind of trading sideways, but we're, as you know, we're in the upper range of this rising wedge, and the market really has not done a whole lot since the end of June. So it continues to struggle here. There's a lot of internals in the market that are weakening. It's kind of interesting if you look at volume. Volume's kind of been falling, for a long time now, for a couple of years actually. But the bullishness in the market is getting louder and louder and higher and higher. So usually that's the market tends to fool the most amount of the people the most of the time. So I would say that if the bullishness is at an extreme, which it is, then it's probably trying to fool us. So let's zoom in here and take a look at the S&P 500 here for a second. One of the things you'll notice is these are just daily bars, but if you see here, we have a high day here. This is a high day, and then you can see here this black candle here closed below this high day here, and that was met with more selling before it took off and went up. Here you can see we had a close below the high day. Actually, this was the high day, so let's not look at that one. How about this one? This is the high day, and then we had a close below the high day, and you can see that was ultimately met with more selling. So a lot of times when you get this red candle here was Friday, and a lot of times when you get a close below the high day, like this was the high day here. Let's just mark that. That was the high day, and you can see here was the close right here of this candle. So we got a close below the high of the low, excuse me, of the high day, and usually that's met with some more selling. Now that doesn't mean it couldn't kind of go up and then come sell off, but usually you'll see a couple of days or so of selling at least when you get a candle like this. So in fact, we could go look at, and that may or may not happen. I mean, it could actually open up in the morning and travel up maybe to a new high, or kind of roll over. We don't really know. But a lot of times if you get a candle a day that closes below the previous day, and the previous day was a high, a recent high, swing high, then you usually are met with some additional selling. But we'll just see. There's no way to really know that except to just wait and see how things work out. But the market, you can tell the market, let's zoom back in again, I forgot to do something. You can tell the market is kind of in this, it's really a trading range right in here. So it's kind of bouncing, ever since the end of June, it's really kind of been in this box. So if you've been out, there's not much opportunity cost. If you've been in, you haven't made much. I mean, it's just kind of doing a whole lot of nothing. And sometimes the market does that. In fact, most of the time, it's said to have been in a trading range. So this, for example, could be a trading range from here all the way to here. Anyway, I think one of the things I want to talk about today is just the interest rate market, the 10-year Treasury. This is probably the largest and most liquid market in the world, and this is the one the Fed has been actively participating in. This is the one your home mortgages, unless it's if it's a fixed rate mortgage, this is the market that your fixed rate mortgage is based on. And we talked about this being the first move off the low, and if that was the case, then this would be the first correction off the first move, and that the next move up would be very significant. Now, one of the things I'm kind of starting to see here is it looks like to me that the interest rate market wants to go a little lower. We initially had this box on here, and it pulled back nicely to this box and then bounced. But it bounced to a lower high here. In fact, this consolidate, we would have liked to have seen this get up above this consolidation pattern right here. This let me zoom back in. This triangle pattern. These tend to be consolidation patterns. But you can see that when it came up here, it came up to here and then rolled back over. So that's telling me probably this has got a little bit more to the downside. It's probably going to break through this support. Now, you know, it's a big market. It doesn't move a whole lot, but it doesn't look like it's through coming down. So if you're in those bond funds still, you've got a little time to get out of them. I still think that there's a lot of risk in the bond market, and if you're stuck in this bond market when this makes the next move up, you're probably going to lose a lot of money. So just be wary of that. Now it looks like there's still some room to make some money if this does in fact break this low on a closing basis. You could see this even fairly rapidly come down here and have this be the support area. So especially, let's go back to the S&P 500. Especially if the S&P 500 starts to sell off, because what happens when the S&P 500 starts to sell off, the broad market, a lot of the institutional money, if this starts to go down, a lot of the institutional money will flow into the 10-year Treasury and other shorter-term Treasury markets, driving those rates lower and driving the prices higher. So we'll just keep an eye out for that. There's no guarantee that's going to happen, but it's certainly shaping up. Let's take a look at the Dow. The Dow, to me, I don't know. It seems a little weaker, but it's really kind of doing the same thing the S&P 500 is doing. You got this trading range in here. It looks like it sold off a little harder on Friday than the S&P 500, and we'll just see. You know, I mean, this could stop right here and turn and go higher, or it could go down a couple more days and then bounce. Rarely does the market just sell off and go straight down. I mean, that's not going to happen. It could happen, but it just doesn't happen much. I mean, you almost never see. The market usually gives you some warning. You know, it might, you know, come down like this and then up and then down, and it might chop around a little bit, and then, you know, maybe in this area after it's gone back up, whoops, messed up. After it's gone back up, then it could come down. Same kind of thing we were talking about in the interest rate market. You know, if this is the initial move off the, in this case, the top, then we would look for a correction, and then the next move into that should be significant. We'll keep an eye out for that. That's certainly not. That's something we're not in danger of at this point. Let's take a look at the euro. The euro-US dollar is a very important market. Let's back this up a little bit. Let's look at a 5-year. So you can kind of see the euro. It made a low here, and then this is a higher low. And normally this is, this is a great place to enter from on a long position. If a market moves up in a swing and pulls back to a higher low, you can enter, somewhere in this area. And that's usually a very good investment or trading opportunity. The interesting thing here, though, is it kind of started pulling back here, then it made another attempt, and it looks like it's not wanting to get above this 140 area. Now we'll see if it makes another attempt, but it could be that this is kind of an arching, kind of a topping pattern, where you have a high, a higher high, but the highs are getting smaller, and then as it rolls this way, they start getting lower, and then you get a sell-off, pretty good sell-off. So this looks like near-term support to me. If this breaks, it looks like we're going to come down to the 120, 127 area. If that breaks, then we'll probably retest these lows down here around 120. But this is an important market. You can see it's actually open right now. It's trading. Right now it's at 134.33, and it's actually trading Sunday evening here. Another thing we should look at is probably the volatility index. This is a 5-year chart of the volatility index, and you can see volatility really peaked here in May of 2010. It kind of sold off and then came back. You know, I had this bound in here. To me, the market gets really dangerous when it's above what is this, about 15.5, 16 to this 37 area. This is if we spike into this area, we probably don't want to be long the S&P 500. So, but we're going to watch that closely, and I'm going to give you plenty of notice before that happens. Let's take a peek at gold. I know there's a lot of interest in gold. You can see back here in oh, this was this high back here, which may not be. It's not on the screen. I'm over here left of the screen. You can't see. You can see me here, but you can't see me over here. Gold peaked out in, let's see, when was this? September of 2011 at 1923.70, and it's made a move. This initial move down, bounced up, and then it made a really significant move down. And this consolidation pattern, this narrowing triangle, these tend to be what we call consolidation patterns. And so anytime you have a big move like this, a big strong move either up or down, the market tends to consolidate for some period of time. But these are usually trend continuation patterns, so that tells me that gold is not, this is not a bullish situation for gold. This means gold is going to make a new low. And typically you can come into about, let's say right here, what's that, 1432 minus 1180. It's about $350, and so you can subtract, you know, about $300 off of this when it breaks out. So that puts gold around, you know, 900 or something like that. And I think maybe that's a little aggressive. Maybe 1,000 is a better number, but something around there. The most important thing is gold is going to make a new low. So for those of you thinking about buying physical gold or buying the GLD or investing in gold in some way, gold or silver, and gold and silver tend to move together. So you can pretty much watch the gold chart, and you can buy silver, you know, at key times, the same times that gold is trading well. Now this is a weekly chart, so each one of these bars is a week, and this is the continuous contract for gold. Is what you're looking at here on the screen. Well, that's about it for this week, guys. Guys and gals, there's a lot of news. I mean, if you listen to the news, you know, for entertainment purposes, just don't get too hung up in it. The news will mislead you every time, and it's just a frustrating way to try to make investments. So steer clear of that. You can listen to me. There's other people online that are doing some great things and watching out for fellow investors, and you can certainly watch those people as well. But you know, remember what we're trying to do here at the Middle Class Investor. We're just trying to keep you out of a massive bear market. So my goal here is to watch this market closely. If I start to see on the charts, if I start to see the bear market developing, I'm going to sound the alarm. But at the end of the day, it's your decision. You have to decide whether or not you're going to go to cash, you're going to go into some other type of investment that is not going to go down if we have a big bear market. Maybe soon we'll talk a little bit about, you know, the catalysts of a bear market. and you can start kind of researching that in the media or whatever. But you know, the market can stay elevated for quite some time before it sells off, and so I think what you're seeing is you're just seeing the last little backing and filling going on before we start to sell off. Now, the sell-off could be mild. I mean, it could be, you know, 5, 10, 15%. But it also could be much larger. And the point is, we don't really know if we're going to have a 10% pullback or if we're going to have a 60%, you know, crash. So the best thing to do if you start to see a trend change is just kind of go to the sidelines and wait. And just get out of the way. One of your greatest advantages in the marketplace is your ability to go to cash. Large institutional investors, by law, cannot be in cash. They cannot have more than 5% of their portfolio in cash. And by definition, that's one of your biggest advantages in the marketplace, is the fact that you can go to cash and it's not illegal for you to be in cash. So, you know, we want to use our advantages to our advantage, and not get stuck doing the things the institutional guys have to do by law. So anyway, we'll talk more about that in the coming weeks. But follow me on Twitter at InvestorClass, or you can go to YouTube. In fact, let me go to YouTube real quick. This is what you'll see if you type in Middle Class Investor into YouTube. You'll see a bunch of videos here. You can go back and watch some of them, or you can just stay current, you know, and watch the most recent one. Some of the earlier ones we talked about things like technical analysis. What is it? We talked about support and resistance. We talked about some principles that I use here in this video, and it might be good to go back and review a couple of those earlier videos. I pull in some pictures of the bond market where we look at kind of a 33-year cycle in bonds, and we talk about kind of where we are in that cycle. So there's some good stuff in some of these older videos, but I'm using this kind of this red and black chart here, so it's pretty easily visible. Early on I wasn't using that, so it should be pretty easy to spot these videos, or you can find this logo, a Middle Class Investor. But that's it. You know, I mean, you can copy the link. Let me show you. For those of you who don't know, you can click here and hit right-click, copy, and then you can paste that link into an email and send it to your friends or your family members. And it's a quick, easy way for them to find the latest video and things like that. So anyway, until next time, guys, thanks for coming in and watching the Middle Class Investor. Just be smart with your money. You worked hard for it. Don't give it away to the market. It does not deserve it. You deserve it. So come back each week and watch your videos, and we'll keep you out of trouble. Thanks a lot, everybody. Take care.